Welcome to Debt Matters, the podcast where we break down the latest UK news shaping debt collection, credit control, arrears, recoveries, and the payments landscape.
Glad to be here for this one.
Yeah, so imagine waking up to find that your baseline cost just to exist, like to keep the lights on and a roof over your head, has basically swallowed your entire paycheck.
Right, before you've even had a chance to buy groceries.
Exactly. And that is no longer some hypothetical worst-case scenario. For a growing portion of the population, it's just the daily math now.
It's the new reality.
Yeah. So our mission today is to unpack the newly released 2025 data from StepChange. We really want to understand exactly why struggling to pay for absolute basics is becoming the baseline environment for households.
And by extension, what that means for creditors, because you really can't separate the two anymore.
You can't. And to set the stage for you, I want you to think about household finances like the foundation of a house. So for years, financial strain in the consumer market showed up like cracks in the paint, or maybe a loose shingle on the roof.
Right, people falling behind on credit cards, personal loans, things like that.
Maybe a catalog purchase, yeah.
Which, carrying your analogy forward, those are surface-level issues, right? I mean, they create immense stress for the consumer, obviously, and they require operational focus from lenders. But they are not the structural base of the home.
No, because a person can default on an unsecured personal loan and still have a place to sleep. They can still have heat for the winter.
Exactly. The underlying structure holds up, even if the exterior looks a bit rough.
But the new StepChange numbers we're looking at today, they show cracks in the concrete foundation itself.
They really do.
We are talking about rent, energy, and mortgages. The very structure is under immense pressure. We need to look at the exact numbers driving this structural issue.
We do, because we have a pretty stark year-on-year comparison from the 2025 data.
Lay it out for us.
So first, just looking at the overall picture, average household arrears have increased by 11%.
11%? Wow.
Yeah, that's a jump from £3,911 up to £4,345.
That's a massive leap in just 1 year.
It is.
Yeah.
And alongside that, the data tracks average unsecured debt, which that rose by 8%.
So that went up too.
Yeah, moving from £15,672 to £16,874.
Okay, let's unpack this. Because looking at an 8% rise in unsecured debt, doesn't that suggest a lifestyle or, a behavioral issue?
Well, you'd think so at first glance.
Right, because if priority bills are literally drowning a household, why are personal loans and credit card balances still climbing? I mean, are people just refusing to cut back on discretionary spending, or is there a different mechanism at play here?
It's definitely a different mechanism.
Because from a collection standpoint, that distinction dictates your entire strategy.
Absolutely. And what's crucial here is the behavioral shift. When you see priority arrears building on core obligations simultaneously with unsecured debt, it points to a severe liquidity trap.
A liquidity trap.
Yeah.
So they aren't just buying things they don't need.
Exactly. Consumers are not taking out personal loans to go on a holiday or buy a new television. They are using credit cards to buy groceries. They're using them to put fuel in the car.
Because their entire paycheck is already gone?
Right. It went to a mortgage payment that jumped by, say, £500 a month. So they're actively choosing to pay the minimums on revolving credit just to keep those lifelines open.
Even if it means defaulting on a utility bill.
Even then. Because they need the available credit just to eat. It is an issue of ability to pay, not willingness to pay.
That turns the traditional risk model completely upside down.
It really does.
I mean, in the past, collections often operated on the assumption that a customer had the funds, but was just choosing to prioritize other spending. Like, we built entire contact strategies around finding that hidden liquidity.
Right, the old can't pay versus won't pay dynamic. But this data aggressively points to can't pay. Lower-income households are taking the heaviest hit here. They're trapped in a cycle where paying the heating bill means defaulting on the credit card.
And paying the credit card means missing the rent.
Exactly. They're juggling daily living costs while trying to clear older debts. And going back to your analogy, when the foundation is cracking, the paint on the walls becomes completely irrelevant.
It doesn't matter at all.
Right. The risk picture for the entire sector changes when the consumer literally lacks the capital to fulfill their obligations.
So let's look at the specific foundational categories where this lack of capital is showing up most acutely. You mentioned the overall arrears went up 11%, but the individual priority bills, paint a much harsher picture, don't they?
They really do. Energy arrears rose by 9% in 2025,
Up to what?
climbing to 2,560 pounds.
Okay.
Rent arrears went up 15%, reaching 2,372 pounds.
15% is huge.
It is, but the sharpest increase by far was in mortgage arrears. That surged by 22%.
22%.
Yeah, jumping from 10,239 pounds in 2024 to 12,534 pounds in 2025.
A 22% spike in mortgage arrears is just massive.
Mm-hmm.
What is the actual mechanism driving that specific surge? I mean, we hear a lot about interest rates, but why are we seeing such a dramatic leap in the 2025 data specifically?
Well, it comes down to the delayed impact of fixed-rate mortgage cliffs.
Oh, right. Because of the base rate.
Exactly.
Right.
When the Bank of England raised the base rate rapidly a couple of years ago, not everyone felt it immediately. Millions of homeowners were insulated by 2-year or 5-year fixed-rate deals that were locked in at under 2%.
Yeah, they were completely shielded.
For a while, yes. But throughout 2024 and into 2025, those deals expired. So homeowners are suddenly remortgaging onto variable rates or new fixed deals at 5 or 6%.
Oh, wow. So the shock just takes time to materialize in the arrears data.
Correct. A household doesn't default the very day their rate goes up.
Right. They try to make it work first.
Exactly. Month 1, they absorb the shock by draining their savings. Month 3, they start leaning on the credit cards we discussed earlier. Month 6, they start missing payments.
So by the time it shows up as a formal multi-thousand-pound arrear in the StepChange data,
The household has been fighting a losing battle of attrition for the better part of a year. It's a lagging indicator of structural failure.
which totally explains why the rent arrears are up 15% as well, because landlords facing those exact same mortgage rate hikes are passing the costs directly on to tenants.
Through aggressive rent increases, exactly. Pushing the tenant past their breaking point.
And unlike a homeowner who might, I don't know, have some equity to negotiate with or something, a tenant in the private rental sector has very few levers to pull.
None, really. If the rent goes up beyond their income, they simply fall into arrears immediately.
It sounds incredibly bleak for the consumer. With the sheer weight of these numbers, you have to wonder if the data offers any relief at all. Or are we just looking at a strictly downward trajectory here?
Well, there is one modest positive trend, though it does require some careful interpretation.
Okay, I'll take any good news we can get.
So, StepChange tracks this concept of a negative budget. This describes a scenario where a client's absolute basic living costs exceed their income.
So before they even pay a single debt.
Exactly. Before they allocate a single penny toward debt repayment, they are mathematically in the red just from existing. The proportion of clients in a negative budget actually fell.
Oh, it went down.
Yeah, it dropped to 28% in 2025. For historical context, that was 30% in 2024 and 32% in 2023.
So we are seeing a slow, incremental reduction in the sheer volume of people whose baseline math simply does not work.
We are, yes.
But wait, looking closer at the composition of that negative budget group, there's a heavy caveat here.
There is. You spotted it.
Among those still trapped in that negative budget, the proportion who are unemployed and actively seeking work increased by 5 percentage points over 2 years, reaching 24%.
Yeah, that is the hidden weight inside the statistic.
It's brutal.
It is. We have a shrinking overall pool of people in a negative budget, but the ones remaining in that pool are increasingly trapped there because they do not have an income stream at all.
Rather than just suffering from high expenses.
Exactly. And they are actively seeking work, which indicates a real desire to remedy the situation, but they remain stuck.
If we connect this to the bigger picture, this tells us that job market uncertainty is adding a really heavy layer of stress to the collections environment.
Absolutely. Even though those dramatic inflation headlines from a year or two ago have cooled down, the embedded affordability pressures remain stubbornly in place.
Right, because prices didn't drop. They just stopped rising at such a terrifying speed.
Exactly. The compounding effect of the last few years has permanently elevated the floor of living costs. So an unemployed person actively seeking work is facing an insurmountable mountain.
The gap between unemployment benefits and the new baseline cost of living is just a chasm.
It is. They are trying to secure employment while fielding daily contact about rent arrears and utility defaults.
The psychological toll of that scenario has to be immense.
Oh, it's staggering.
And from a practical standpoint on the collections floor, it means your agents are engaging with consumers who are highly vulnerable, highly stressed, and operating with literally zero financial margin for error. And if this affordability pressure is a permanent fixture rather than a temporary spike, the traditional ways of collecting debt are going to fail.
Completely. It forces a harsh reality check for the industry because the traditional model relied heavily on volume and persistence, didn't it?
Oh yeah. The operational playbook was simple. Send the letter, run the automated dialer, make the call, secure the product to pay. But using an automated dialer in this environment is like trying to bail out a leaky boat with a sieve.
That's a great way to put it.
I mean, if the core problem is a fundamental lack of affordability, the volume of attempts doesn't matter. The underlying mechanism is completely out of fuel. You can crank the engine all day, but without petrol, you're just draining the battery and creating friction.
And creating regulatory risk, too. When the consumer's core issue is an absolute lack of resources, persistence creates massive regulatory risk.
Because the regulators are watching this.
Oh, they are looking at the exact same StepChange data we are discussing today. They know the consumer is structurally strained. If an agency runs a high-frequency contact strategy against a portfolio where the consumers mathematically cannot pay,
that agency will be penalized.
exactly, for unfair treatment and harassment.
Which transitions the conversation toward the proposed solutions. Because StepChange is not just publishing this data as an academic exercise, right? They are demanding structural action.
They are. Vicki Brownridge, the CEO, is calling for much stronger government intervention.
Specifically advocating for national social tariffs in energy and water, right?
Right.
To protect low-income households.
Yes, a social tariff represents a major structural change in how essential services are billed. It essentially means creating a subsidized, lower pricing tier strictly to protect low-income households and individuals with high vulnerabilities.
And the water industry has experimented with forms of this, but rolling it out at a national level for energy, that fundamentally alters the market.
It does.
How does that mechanically work behind the scenes? Because it's not just like a promotional discount.
No, not at all. It is a deliberate pricing structure funded either directly by the state through tax revenues or cross-subsidized by charging slightly more to higher income, higher usage consumers. The goal is to ensure the baseline cost of heating a home and having clean water never exceeds a certain percentage of a low-income household's take-home pay.
And she's also pointing to a broader need to raise household incomes and build financial resilience alongside that.
Yes, she is making the case that the math of daily life in the UK is broken for the bottom quartile, and the government needs to step in to fix the equation.
So people aren't forced into the collection cycle just to drink water and keep the lights on.
This raises an important question. What does this mean for collections teams operating in 2026?
Right. Because we can't just pause operations and wait for government policy to completely solve the macroeconomic environment.
Exactly. Accounts are entering arrears today. Portfolios need to be managed this quarter.
So let's lay out the practical reality for the listener managing a floor right now. If the traditional collections approach is failing, if the automated dialer is the broken engine, what are the actual diagnostic tools creditors should be using? They need entirely different tools.
They do. First, traditional approaches must be replaced by precision and segmentation. You need tailored repayment plans and data-led early intervention.
Data-led being the key word there.
Absolutely, because if you wait until a customer's mortgage is 22% further in arrears and they default on their credit card, the structural damage is already done.
So what's the diagnostic tool?
It's utilizing open banking and transactional data to spot the shifts in behavior before the default happens.
Oh, okay.
Right.
So you are looking for the customer who suddenly, say, cancels a direct debit for a gym membership.
Yes, or who shifts their grocery spending from a debit card to a revolving credit line.
Precisely.
Yeah.
You spot the liquidity trap forming in real time.
And then you reach out proactively with support options and restructuring, rather than waiting for the missed payment to trigger a hostile collections cycle.
That makes a lot of sense.
Second, account portfolios will inherently carry greater vulnerability moving forward. The percentage of your accounts requiring specialized, sensitive handling is going to increase substantially.
Which means the operational backend needs a massive overhaul. Agent training cannot just be about negotiation and objection handling anymore.
No, not at all. It has to include deep empathy training, suicide prevention awareness, and a thorough understanding of the welfare benefits system.
So they can actually signpost customers to helpful resources.
Exactly. And your quality assurance metrics have to change too. You cannot judge an agent's success purely on cash collected per hour if they are spending 45 minutes untangling a complex vulnerability case.
That's a really good point.
Furthermore, creditors must expect slower repayment performance across the board.
Because the disposable income just isn't there.
Right. Repayment plans have to be stretched out over much longer periods. This leads to increased pressure on forbearance strategies. Lenders and debt purchasers will need to offer more breathing space, more payment holidays, and highly flexible restructuring.
The operational cost of holding accounts in suspended animation while a customer tries to find work or stabilize their housing situation, that is going to rise.
It is. And lastly, there will be far more scrutiny on the treatment of customers in financial difficulty. Compliance teams need to be on high alert.
Because the Financial Conduct Authority and other bodies will be watching very, very closely to ensure firms are acting with absolute fairness.
A single systemic failure to identify vulnerability in this environment will lead to severe enforcement action. The entire ecosystem has to shift from a mindset of recovering debt to managing financial distress.
So what does this all mean? The takeaway for you, the listener, is clear. Essential bill arrears are no longer a one-off cost of living aftershock. They are the new normal.
They really are.
We cannot keep operating under the assumption that things will eventually revert to a 2019 baseline. This elevated pressure is the permanent environment now.
It's shifted the landscape entirely.
Exactly. From a simple consumer finance story about overspending to a baseline operations reality for creditors, you have to manage this daily. You have to adapt your contact strategies, invest in diagnostic technology, and scale your empathy to handle a consumer base that is structurally strained.
I will leave you with a final thought to ponder as you review your own portfolios and operational strategies for the year ahead.
Let's hear it.
If essential utilities and housing are now the primary drivers of consumer debt, how long until utility providers and local authorities are forced to completely reinvent their core business model?
Oh, wow.
Think about the trajectory. How long until a water company or an energy provider has to function more like a state social support system?
Assessing welfare, employment status, basic affordability at every touch point.
Exactly. Rather than operating as a traditional transactional business, the lines between debt collection, utility provision, and social care are blurring rapidly, and navigating that blurred line will reshape the future of this entire industry.
That is a sobering but essential perspective for anyone managing risk and recovery in this space. Thank you for tuning in today and letting us unpack this data with you. We appreciate you taking the time to look past the top-level percentages to understand the exact mechanisms driving consumer behavior. Until next time, take care and keep an eye on the shifting landscape.